Good morning from our global headquarters here in New York. I'm Manish Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set that agenda.
Pause for thought. Dollar and bonds reassess the Trump trade, pairing their post-election exuberance. Standing his ground, Fed Chair Powell makes clear he is here to stay.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
President-elect Trump's cabinet taking shape. Susie Wiles is named White House Chief of Staff. And don't miss our exclusive interview with the HSBC CEO of Corporate and Institutional Banking, Michael Roberts, later this hour. Man, is really looking forward to hearing your conversation with him.
Yeah, the risk is, of course, blowback from tariffs around the world here in the U.S. Let's get to the end of the week. We're above the 6,000 level on equity. So many people had this up as their target, and some people even have it above 6,500. Love a fact. We found a fact from Michael Hartnett. $20 billion went into U.S. equities on election day, Danny. And I put up small caps there for you. It's had a blinding week, 7.8% in the 4 days. Let's see how it opens today. $3.8 billion went into small caps. But to understand the narrative from Jay Powell yesterday, I think, is to understand U.S. exceptionalism. The U.S. economy is performing better than any of our global peers, and businesses stay stronger. To the bond market, this is where there's a small recalibration relative to the exuberance of the equity markets. 10-year yields dropped by 10 basis points yesterday. You did the math this morning, so I'll give you the glory.
Oh, thanks, man.
Post-September jumbo rate cut. What have we done in the bonds?
Oh, you're even letting me say it. We're up 60 basis points for the 10-year yield. And this, I think, is interesting because it would have given Powell an out to kind of address the politics without actually addressing the politics. He was asked about this bond market, whether he was worried about higher yields. He basically said only material changes to financial conditions matter. And he didn't see this as a material change. So at what point do higher yields, maybe led by growth, maybe led by politics, cause Powell to need to be able to pay attention and to react to it?
Look, I think the bar to a pause, it depends whose note you read in your inbox, to be fair. The bar to a pause for some people is very, very low. In other words, they just don't know what's coming. I think the language he used around the economy is very strong. There's a diminishing downside risk as the economy remains strong. And for Deutsche Bank, the bar for skipping a cut at the next meeting isn't that high.
I will say, I think success for central bankers is boredom. And that was a pretty boring meeting, except for the comments about Trump, which were one-word answers. Brilliant. I think in that regards, Powell had a pretty good meeting. Well,
let's just reflect back on the power of the word no. Let's listen to the chair himself, Jerome Powell, in regards to speculation that the president-elect might ask him to step down. Punchy.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Do you believe the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Bilal Hafeez, CEO of Hive, joins us now. A forceful rebuttal, a clear narrative. You're either setting up for quite a head-to-head next year between President-elect Trump and Powell. But what's your take? Because the dollar market listened to that one word, and it actually means a lot to the hegemony of the U.S. currency.
Yes, absolutely. One of the big risks of the Trump second term was a possibility that there'll be much more political influence on the Fed, and as a result, that could diminish the role of the U.S. dollar and U.S. assets in the eyes of investors. So that sort of very definitive no helped support the dollar in that sense, on the risk premium sense. So that was kind of expected. Trump would say that, but it does help support the credibility of the Fed.
Bilal, we also heard from Powell saying we don't guess, we don't speculate, and we don't assume. Is this an issue with the Fed's framework in general? The fact that they are so data dependent, it means that even though we are pretty sure that we're going to get some sort of pro-growth inflationary type tilt from the Trump administration, that the Fed feels that its hands are tied, that it has to wait until the actual effects of that.
Yes, I mean, I think this is one area where the politics does come into the picture. And if we go back to 2016 and you look at the transcripts of meetings we had back then when Trump got elected in the months leading up to his inauguration, what you did find that there was lots of discussions within the Fed about what the likely fiscal impact would be of Trump. Yet publicly, they had this line that they said that they'll have to wait to see what these fiscal policies would be. So I think this is political, that Powell doesn't want to be viewed as entering a political debate. At some level, they have to acknowledge that there will be this fiscal stimulus. But at the same time, the track record they've had over the past year or two has been that they are not that confident about their forecasting abilities and that they do end up relying on the last data point. So in that respect, it's consistent with what they've been, the way they've been behaving over the past year or so.
I'm just looking at the 5-day chart on the 10-year government bonds. As Danny said, post the jumbo cut, at the max point, we did 70 basis points on the upside. That is monetary policy. The debate is now a recalibration by the bond market until they see the policy. So when you look at this tempering of the steepening, tempering of the spike in yields, do we find a new trading zone? Do we temper our exuberance until we get the detail?
I think this week has been obviously a very wild week. Most market participants, most of our clients who are amongst the top investors in the world were positioned for a Trump victory. And so in that sense, they have prepared for high yields and so on. So to the extent that we saw a big move as soon as the results came out, and this week, I think, is position adjustment. So this week, I wouldn't take the price action of this week too literally. I do think, though, over the coming few weeks, we'll get to see who the Treasury Secretary appointment will be under the Trump administration, and we'll get more details of any plans that we'll have on the fiscal side. So my bias would be that U.S. yields will end up going higher, that we're not necessarily, that the rise in yields hasn't necessarily ended, and that we could potentially break to new near-term highs in yields.
What drives that, Bilal? Is that just policy? Is that a red sweep? What needs to be priced in at this moment?
I think there's a couple of factors. I think one is that the Fed doesn't seem to be that worried about inflation, and I do think that inflationary risks are increasing, whether it's through tariffs, fiscal, the possibility of fiscal stimulus, whether it's just U.S. data, which I think in general is fairly robust. So one is I think that more inflation risk needs to be priced. And then secondly, over the coming few weeks, I think we will start to hear more announcements or leaks of announcements about the Trump policy agenda, which will end up being things like fiscal stimulus, tariffs, and so on. I think all of this collectively will be enough to drive U.S. yields higher.
Let's just take that a little bit forward. I'm in a conversation with a couple of people on the IB at the moment in terms of who might join that table at the White House. Scott Bessent, Kevin Hassett, Kevin Warsh. And this is to quote State Street. These are not crazy people. These are pretty orthodox conservative thinkers who, in the end of the day, understand that you shoot yourself in the foot if you challenge the Fed's independence. So I think it's about who is surrounding Donald Trump in Trump Mark II. And to that point, these are not crazy people from an economic policy point of view.
Absolutely, that's correct. And if we were to get one of these names, I think what we'll end up seeing, the moderation, I think, would be more on the tariff side. On the fiscal side, I think we still will get a net stimulus, because when Trump came in 2016, there was a net stimulus. When Biden came in, there was a net stimulus. Whenever a president comes in and they have control of Congress, they end up implementing some kind of stimulus. And you have to remember, the unemployment rate has been increasing over the past year, so there is somewhat of an output gap, you could say. So there is room to have a stimulus, in the U.S. economy. So to that extent, I think whatever these names are, I think a stimulus is on the cards. Where these names could have an impact would be tariffs. So if we were to get like a Bessent or someone like that, then what we could end up seeing is that the tariffs are a negotiating tool to improve trade terms with different economic blocs around the world, which could end up being something that could end up being more positive for markets, for sentiment. In contrast, if we were to get someone like Lighthizer, who's much more aggressive, then that could be something which would be perhaps more negative for sentiment overall.
Although we can't forget, in the first Trump presidency, someone like Gary Cohn left because he disagreed with Trump over tariffs. That could happen again. Bilal, really great to have you on the program this morning. Bilal Hafeez of Macro Hive. Manis, let's get to some of the other top stories that are trending on the terminal this morning. Richemont's profit dropped in the first half of the year. Luxury demand for watches continues to fall in China. Its jewelry division, that did remain resilient, but demand for luxury timepieces have broadly softened after a pandemic-era boom.
TSMC had the slowest pace of growth since February over moderating AI chip demand. That's according to Nikkei. It also told multiple Chinese customers that it will suspend production of its AI and high-performance computing chips.
China has announced a $1.4 trillion program to refinance local government debt to support a slowing economy. President-elect Trump's victory has fueled calls on Beijing to strengthen policies in order to offset a potential drop in exports due to the threat of tariffs.
Coming up on the show, Trump picks Susie Wiles as Chief of Staff, the first ever woman in the role. More on the story.
And later in the hour, we're going to catch up with Keith Lerner of Truist on the election aftermath here on your Bloomberg Brief.
It's Bloomberg Brief. I'm Manish Krenny alongside Danny Berger here in New York. President-elect Donald Trump, he's named Susie Wiles as his top architect of 2024 presidential campaign as his White House Chief of Staff. Wiles, a veteran Republican political operative, will be the first ever female White House Chief of Staff and hold considerable power over operations in the West Wing.
And meanwhile, Manis, we are still monitoring the U.S. House race. It's teetering on uncounted votes in about 27 congressional races. The final tally will decide whether President-elect Donald Trump and Republicans have a full grip on the government. Races have yet to be called in about half a dozen GOP-held seats in California and districts scattered elsewhere. The balance of power does seem, though, to be skewed to the Republicans, with Polymarket pricing in 97% odds that they get the House.
Well, with a new administration to get up and running, the war in Ukraine has taken center stage, both with Vladimir Putin and Volodymyr Zelensky seeking an edge with the president-elect Trump. Hungarian Prime Minister Viktor Orban says, quote, the Americans are going to get out of this war. They're going to quit this war. Well, Orban is hosting the European leaders in Budapest, and joining us live on location is our very own Oliver Crook. Oliver, it seems as if Viktor Orban has seized a moment of weakness in Europe and stepped into this. He's been slapped down by the European Council president. But what are his overtures so far? We know him and Trump have a close relationship, but he's really taking the opportunity here, isn't he?
Absolutely, Manis, and that is exactly what Orban is hoping. He's hoping to be Trump's man in Europe, and that is really, they've had a very close relationship for a number of years. He's been in the United States, he's visited, there's been a lot of contact between the sort of two administrations, and we've also heard that from some Hungarian officials that they have been involved in some part of the sort of policy proposals that Trump is coming up with. And I, in fact, caught up with Viktor Orban's chief political advisor about how they felt the moment that they heard that Trump had been elected. Have a listen.
Of course, we were drinking champagne. It's a big and important week for Hungary. I think it's a big and important week for the entire world. But U.S. elections has a meaning for European politics as well, and we are very happy. It's probably just a coincidence, but today and tomorrow, European leaders are coming here and discussing how Europe should react on the consequences of the American elections, and we have an opportunity to talk.
And that man has really been the sort of liaison officer between the Hungarian government and Donald Trump. And what they're really hoping is that this will, A, force a sort of change in the European stance towards Ukraine, which, of course, leaders here are pushing back against, but also a much wider thing. There's a much larger project at play here. When I spoke to him, he said, this is not just about Ukraine. This is about sort of getting the Hungarian agenda on there and basically pushing back against what he calls this sort of Western liberal and woke values.
What is the pushback to the pushback, Oliver? For other European leaders, what has been the sense, the mood that you're getting there, and what they think is their ability maybe to curb some of Orban's ambitions?
Yeah, so listen, we've heard from every sort of European leader coming in. I've spoken to a number of them as they were walking in and had a couple of interviews, and basically everyone's message is the same. They will not sort of move on Ukraine, that basically Ukraine will have the full support of Europe, and that nothing will change from that perspective. I also spoke to the Danish Prime Minister just moments after she got off the phone with Donald Trump, and she said something that we've heard a lot here, basically trying to have a cautiously optimistic tone on how to deal with the Trump administration. No one here wants to fire the first shot, so everyone is going at it as a sort of an optimistic optimistic sort of stance towards things. The other question, though, is that she's probably one of the best people to talk to about this because she's seen the other side of Trump. She was in power when he was president the first time, and he canceled a state visit to go see her over her sort of desire not to sell the United States Greenland. So this is sort of what the United States and what the Europeans are sort of looking at when they're sort of imagining what the Trump presidency looks like, and particularly putting through their competitiveness agenda, which is going to be the front and center today, and trying to push their own Europe first approach to the America first.
Yep, I heard one great line this morning on the radio, which was when it moves from fear to roadkill in terms of policy and delivery. Oliver, great reporting. Oliver Crook there. Coming up in the show, BlackRock in talks with Millennium to take a minority stake, but will it result in a deal? We'll discuss in just a moment right here on Bloomberg Brief.
You're watching Bloomberg Brief. Danny Berger, Manus Cranny here in New York. Let's get you some front page news, a look at what's making headlines around the world. First, we start up on the front page of the New York Times that the San Francisco mayor, London Breed, has conceded her race to the heir of Levi Strauss. Daniel Lurie was a first-time candidate, never held an elective office. The concession came after multiple rounds of counting under the city's ranked choice voting system.
Next up, Wall Street Journal starts with a federal agency warning employees about their phone use amid ongoing China hack. Now, the Consumer Financial Protection Bureau said to not conduct work over their voice calls or texts. Many U.S. officials have already curtailed their phone use due to the hack.
And this on the Bloomberg, BlackRock in talks with Millennium to take a minority stake in the hedge funds. The discussions are in an early stage. Representatives for both firms decline to comment. If anything, Manus, it just shows what a behemoth BlackRock has become. They kind of have their foot in everything from, ETFs have fueled them. They have private assets. And now they're looking at Millennium, the hedge fund, which, again, just kind of expands the reach of them, this biggest asset manager in the world.
And then of course, there is the view, what else is going to happen in this space? It took me back. I was thinking about what else have we seen in the hedge fund space this year. And you remember Bill Ackman? We were going for like $25 billion at one juncture with the hedge fund.
Yeah.
I think eventually it was pulled over.
The one he was going to list.
The one he was going to list. So it's almost an interesting kind of move in the hedge fund space.
Yeah.
If you now go for the portion sale to somebody like BlackRock rather than, well, that's a pretty ambitious IPO, to be fair, that Ackman was trying to sort of pull off. It was audacious.
He thought he could do it because he had a Twitter following, and it turns out that that's not enough to get interest in your IPO.
Danny and I are going to continue to build our Twitter following. We can IPO Bloomberg Brief before you know.
Can't wait. Let's get to this story. Bloomberg Deals reporter. Got it. Manuel Bagori is going to save us here from Manus's idea of an IPO. Manuel, why now? Why is this happening? Why a stake in Millennium?
Danny, we are seeing so much interest in asset managers globally. They're all trying to gain scale and diversify. It's become a common thread in the industry, no matter where and how you look at it. So it's no surprise in some sense that BlackRock is trying to become these so-called one-stop shops, right? They're trying to kind of like grow into the alternative space with this potential move. The talks, as we understand, are very preliminary, so it may or may not reach or lead to any transaction in the end. But it was also interesting, as we reported on this potential deal, that for Millennium, it would be the first time that they open up to a selling potentially an equity stake in the firm for the first time. So remains to be seen whether or not the transaction will be reached, but definitely what we are seeing globally is more consolidation in the asset management space.
Well, Manuel, can I just jump in there?
speaking.
In terms of the bigger picture, okay, we had a moment, Danny and I, reflecting on what Ackman was trying to do during the summer. That was an IPO. That was built on sort of lofty ambitions. But what is the trend here within the hedge fund space?
Well, I think, Manus, I think that what they are trying to see is obviously it's becoming more and more competitive, and for them to be able to fundraise and to be able to deploy, they need scale, and for someone like Millennium to be able to form a partnership with the biggest asset manager in the world, that would definitely give them a big boost. Also, it will give the founders and the owners also some liquidity as well. But I think just these tie-ups between industry leaders are definitely happening. We're seeing more of them. Just keep in mind the ones that we've seen in the alternative asset management space as well earlier in the year. And I think we are poised to see more, whether it is on hedge funds or whether it's in other strategies. I think there is likely more to come as well.
Manuel, thank you very much for being with us. That is Bloomberg's Manuel Bagheri. Coming up in the show, don't fight the trend. Don't fight the Fed. That's according to Keith Lerner over at Truist. He joins us in just a moment at the end of a pretty punchy week for markets right here on Bloomberg Brief.
From our global headquarters in New York, welcome to Bloomberg Brief. Danny Berger alongside Manus Cranny. Let's set your agenda.
Pause for thought. Dollar and bonds reassess the Trump trade, carrying their post-election exuberance. Standing his ground, Fed Chair Powell makes clear he's here to stay.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
President-elect Trump's cabinet taking shape. Susie Wiles is named as White House Chief of Staff. And don't miss my exclusive interview with the HSBC CEO for Corporate and Institutional Banking, Michael Roberts, a little bit later this hour. Danny, good morning. We got there.
We got there, and equities a little bit softer this morning, led lower by the NASDAQ 100 futures. Risk assets up for the most part yesterday, holding on to their post-election surge, a 49th record high, the strongest three-day move since 2022. Investment-grade credit spreads, the tightest since 1998. Bonds, a little bit different. Treasuries before the Fed unwinding some of those post-election moves. Yields are lower again this morning, 3 basis points for your 10-year at 4.29. 2s, they all closed the day lower. The dollar index, it was its worst day since August, but it gave up about a third of its Wednesday gain. So some of it's still sticking, Manus.
I think it's about a reassessment. It's this moment. You've had this massive exuberance, which we know many people have said has been perfectly rational. You then listen to Jay Powell yesterday, and I think you sort of stand back and you go, wow, this is the Fed of the chair, the chair of the Fed, saying that the U.S. economy is performing better than any of its global peers, and that rams home U.S. exceptionalism writ large in a Fed meeting, and that is, I think, the growth narrative over the pause narrative. And we're going to debate the pause narrative, I know.
Well, I think in that context, this was a substantially less hawkish, I'm not going to say dovish, but a less dovish, rather, kind of meeting than it was in September, talking about diminished downside risk. And this begs the question, where is the bar for skipping a December meeting? Certainly, if you're going to incorporate some of the politics, you'd think that the bar is quite low. But Powell was very clear that they weren't looking at that, him saying that we don't make assumptions. And
I never thought that the word, well, I know that the word no is quite powerful, but I got to hand it to this chair. No in twice quick succession. That man's not for going anywhere. It could be a punchy 2025.
And then a five-word curt answer, not permitted under the law in terms of whether he would be fired or not. So politics has really taken over the conversation, but should it in markets? Keith Lerner, co-CIO at Truist, weighing in, writing this, pillars of this market also remained intact. 1, don't fight the trend, and 2, don't fight the Fed, in addition to corporate profits that continue to surprise from the upside. Keith, I'm pleased to say, joins us now. So, Keith, how much did Tuesday change your outlook for this market?
Yeah, well, first, great to be with you. And the quick answer is not much, because before this, we were still positive. We still believe we're in a bull market. You mentioned some of the basic tenets of our view, which is 1, don't fight the trend. The underlying trend is still positive. Doesn't mean we're not going to see some setbacks along the way. But even more short term, if you look historically, When you've been up more than 15% through October, by the end of the year, you've been up 19 out of 20 times when we've seen this historically. So that trend is still intact. Don't fight the Fed. We had the big Fed meeting yesterday, a lot of debate, like you said, as far as do we skip a meeting or not. I think the more important thing is that the Fed, even though the economy is resilient, is still in easing mode. And whether they go slower or they pause for a bit, I think, in our view, it's more important that the economy stays resilient and we have less Fed cuts rather than that we need more Fed cuts because the economy is slowing as well. And then finally, which you've mentioned, corporate profits. We've had a lot of inconsistencies in the market, swings in the market. The one thing that's been really consistent this year is corporate forward earning estimates for the S&P continue to move higher. So I think if you put that in totality, that the underlying trends are still positive. And now we've got a little bit of clarity on the election side, which is also helpful.
Keith, good morning to you. We had one stat at the start of this show, which I thought was very powerful. $20 billion was poured into the U.S. equity markets on election day. And small caps took in just under $4 billion as well. As a CIO, the narrative for you to add fresh money here at all-time highs, is that predicated more on the growth trajectory and the tax possibilities for next year relative to a pause in the Fed, which is possible?
I go back to, I think you have to think about the economy first, right? Historically, after the Fed cuts rates the first time, a year later, there's a big difference in the market outlook depending on whether you avoid recession or not. So I think the first premise, the baseline, is that the economy proves resilient, and maybe some of these policies on the margin help keep that going. So I think that's important, and I think it's all about corporate earnings. You know, the technology sector, as we all know, is now more than 30% of the overall S&P 500. And corporate profits have been really powered by technology. So our tune would change if we started to see those corporate profits turn, or especially in tech. And the one thing, you mentioned small caps, we've had a pop that likely has more to go, but small cap earnings actually have been much weaker than large cap. So that's why even on a short-term basis, but while small caps might outperform, we're not ready to fully shift position into small caps yet.
It's such a good point, Keith, because often people buy the small cap index without realizing what exactly is in it and what kind of companies are in it, especially with consumer companies. I have to say, we have started to hear the first inclinations of warnings of what politics would mean for some of these companies. Steve Madden, the shoe company, talking on a call after the election, the CIO, saying that they would have to start accelerating their move out of China. Whirlpool, they expect prices to go higher, costs to come under pressure. Church & Dwight, which makes those water pick oil care things, saying that they're moving production out of China. Keith, how do you look at consumer companies in this moment, especially those with international supply chains?
Well, I think the broader point even is, so I've talked about some of the positive. I just also want to be balanced. I think the market right now is focused on deregulation, lower taxes, but there's a lot of unknowns as far as the policy side and tariffs as well. So I think we're going to start to see these kind of jolts of volatility, and that's going to, like, as far as reporting and from what I do day to day, we're going to have a lot more to talk about, whether that's good or bad, right? And then on the consumer side, I think it's going to be, these companies, they will adjust. Companies always adjust, but there's going to be, especially up front, I mean, there's still uncertainty on that side. So I think it's going to be much more selective. Overall, on the consumer discretionary sector, we're neutral, but there's also a lot of divergences. You think about that sector, there's the Amazons of the world, and then the ones you talked about, the Whirlpools and so forth. So I just think it's going to be more of a divergent sector, and it's going to be something where you're going to really have to do more deep fundamental work. And I think a lot of these companies themselves, the CFOs, they're figuring it out. They don't know yet.
I think when you look at this, it's about the promise of tax and trades, the concern about trade and trades, and then regulation, which takes me to the banks. And there's a lovely line. I mean, the banks had a good third quarter. That was driven by NIMs. But if they get a lighter touch regulation, less capital, less aggressive capital, let's say at 9% hike in their capital requirements, that, again, emboldens that narrative, because you've got America first, U.S. exceptionalism. You presumably want to be longer again of these banks.
Yeah, and we were positive on the banks before this, so this just adds a little bit of fuel to that. Again, going back to the economy, banks, they need a good economy for the banks to work. Right now, our view is the economy stays resilient. Credit spreads, you mentioned, at the lowest level in decades. I think that's a positive. You probably start to see a pickup in M&A also, and some deregulation. But also, maybe I'll bring a broader point, too. I know, there's so much discussion and ink spilled about what sectors do better and worse under each president. We've done work on this, and what's interesting, when you go from Obama to Trump to Biden, the conventional wisdom has been absolutely wrong for the most part on this. You know, energy and financials were two of the best sectors under Biden, and under all three presidents, technology has been through the top. So even though we're so focused on the election this weekend, we should. One of our key points is elections matter, but other factors in totality matter more. And as we move forward over the next 3 to 6 months, some of these other factors, again, will get more focus, again, just simply on the economy itself.
Well, hunker down, because it's going to be a social media storm for the next 4 years in the middle of the night. Keith Lerner there of Truist. Coming up on the show, President-elect appoints the first ever female as White House Chief of Staff. Context matters on Bloomberg. It is your Bloomberg Brief. I'm Manish Cranny alongside Danny Berger right here in New York. President-elect Donald Trump named Susie Wiles as the top architect of his 2024 presidential campaign. She will now be his White House Chief of Staff. Joining us now for the very latest is Stephanie Baker, Stephanie, I mean, a very powerful woman in Susie Wiles. She's run many campaigns around this country. She's very well respected internally and externally. So just give us your first take on Susie Wiles.
Yeah, a really interesting pick, not surprising, but the first woman to hold that position, which is a bit of a surprise. She is not active on social media. She's not a presence on Fox News. And you saw when Trump accepted the election win, he tried to get her to speak, and she demurred and refused to do that. She is not a Washington insider, but she stayed as the chair of Trump's campaign throughout, unlike his 2016 campaign, which was fraught with turmoil. So she has run a very professional operation. I don't think she managed to control Trump, the candidate, and his messaging, but she controlled the campaign very effectively and was rewarded for doing so.
Stephanie, you quite literally wrote the book on Putin, and this introduces another dynamic. Viktor Orban was speaking on radio today saying there's military defeat in Ukraine. The Americans will quit this war. How does this change the shape of not just European defense, but the war in Ukraine?
Yeah, I mean, I documented Viktor Orban in my book, Punishing Putin, and the way he obstructed some of the sanctions within the EU against Russia. And he definitely has took a victory lap with the Trump win, and he's maintained the closest ties with Trump among the EU. I think that it presents a real dilemma for Europe because Ukraine has gotten the majority of military aid from the United States, and there's a real question as to whether or not the EU defense industrial base can take over, even if the EU steps up financially to replace a potential withdrawal of U.S. aid. So I think that it really will force the EU to come together, and with Orban opposed to continued aid and support for Ukraine and backing Trump's belief that there needs to be a ceasefire and end to the war, I think it's going to put the EU in a very difficult position.
We're still trying to get the final results of the House of Representatives. A lot of the betting markets have it a 97% probability that it will be a red sweep. Now, this has a number of issues pertinent to the war because it's about funding that war. It's about continuing, I suppose, some of the divisions that we saw over the funding from the U.S. Congress at the start of the year. How likely is it that Republicans take control? And what is the consequence for the war?
Yeah, it's looking likely that the Republicans will control the House, given the way the number of uncalled seats are leaning, and it does have huge ramifications for Ukraine. I think even if Kamala Harris had won, I think it would have been difficult to get another Ukraine aid package through, but it was at least possible. Right now, that's looking very unlikely. You've had a number of, Mike Johnson held that Ukraine aid package up for months, and I think that there's been a real turn within the Republican Party against continued Ukraine aid. And let's face it, those aid packages are keeping the lights on in Ukraine right now. And Ukraine is suffering massive missile and drone attacks every day. Half of its power generation capacity has been taken out, and it really needs aid just to keep going as a viable state. So I think it's dark days for Ukraine ahead, unfortunately.
Stephanie, thank you so much for that. That is Bloomberg's Stephanie Baker. Now, some corporate earnings that we are watching. Airbnb shares falling in the pre-market about 5%. Even though post-market, it had some double-digit gains. That was its outlook for book nights, topping the street's estimate, a signal for an uptick in the holiday season. For more, let's get to Bloomberg's Tom McKenzie. Tom, it's a confusing one. Literally, the difference only a few hours makes between the post and pre-market session. Do we have any sense of why sentiment has turned on Airbnb so much this morning?
Well, it was a mixed set of results, Danny. So the top line in terms of the beat that came through in terms of bookings for the most recent quarter, Q3, that was a beat. And in terms of the outlook, as you suggested, they expect to see a tick up in bookings as well for the next quarter. In terms of bookings, rooms, hotels, of course, the listings, but also the experiences. So that's the top line in terms of the positives. When you break it down as well, they saw some double-digit gains in terms of LATAM, so that space is performing well for them. They're seeing the outbound travel out of China picking up. They're seeing some strength there. They got a little boost from the Paris Olympics as well. But in terms of the net income of the quarter that just reported, that was actually a bit of a miss. And then they guided around the first quarter of next year and said revenues may disappoint because of comparison effects. But most importantly, it seems for the analysts, certainly at Morgan Stanley and Bloomberg Intelligence, is that the margin squeeze could be there for Airbnb in 2025. They're spending, for example, on AI chatbots. That will improve the experience, that's the hope at least, but it comes at a cost, and there's a marketing spend around that as well. So that's a concern from analysts, it seems, and investors seem to be digesting that news. Maybe a squeeze on margins for Airbnb next year.
Well, I certainly chipped into the Airbnb third quarter earnings. I just want to confirm that and put that out there. Talk to me about Expedia, because I think what Expedia tells me, it's like a microcosm of the US. 2/3 of their revenue comes from the United States of America. We have a strong economy. We have consumers that are still pretty resilient. Their stock price reaction, Tom, a little bit stronger this morning.
Yeah, and that stock is up about 15% year to date. It was a cleaner set of results, and partly because of that, Manus. As you say, 2/3 of the revenue coming from the US consumer. They beat in terms of the earnings picture for the most recent quarter, but they also upgraded their full year forecast in terms of bookings. So they see an increase of 5%. That's up from a previous increase of 4% for Expedia. More broadly, what you're looking at is a slightly less challenging picture for the travel picture. Last week, you got Booking coming out with their earnings. They also upgraded their forecast. Bit of a mixed picture when it comes to Airbnb, but broadly, the sentiment seems to be that there is a bit more strength there. Manus, clearly, with those palatial visits overseas, doing his part.
Tom, you have a very embellished view of my lifestyle. Tom McKenzie there, tracking the travel companies. Let's turn our attention to financials now. HSBC's newly appointed head of corporate and investment banking, Michael Roberts, says the restructuring of the lender is to be done at pace, but in a thoughtful way. He joined me for an exclusive conversation on the path forward on combining the entities.
Firstly, it starts with the premise that we already have strong results. Our strategy is not changing. We're very, very comfortable with our strategy. So this is not a strategic change in the least. What this really tries to do, Manus, is to simplify the organization. We're big, we're complex, we operate in 60 countries, and historically we've tried to simplify. We've never really gotten to the level we should. So this is really about trying to simplify the organization, delayering it where we can, and really looking at what our strengths are as a firm. In the main, we're a very large wholesale bank. In fact, this creates one of the largest wholesale banks in the world. So putting it all together, what we want to do is to bring our various coverage organizations together. We have a very large commercial bank. We have a large corporate bank. We have an investment bank. That will all be put together. We've already done that in 39 different markets, if you suggested. LATAM we did recently. It's worked quite well because we take uncertainty out of it. We take layers, we take differences of strategy. And we're one strategy, one go-to-market approach in a much more simplified context.
To get investment bankers and commercial bankers to play together to make money for the institution, is it going to involve a scale of rethinking about bonus remuneration? If you want to create one team, one dream, That is a hard thing to do on remuneration.
Yeah, and that is clearly one of the objectives. That's clearly one of the challenges, is to really create the one Dream One team. We've done it in the past. Clearly, we've done it in those 39 countries. I actually think this simplifies it, because if you have one coverage organization, you have an investment bank, you have a markets operation, you have our transactional banking operations, all running side by side to a very large, now much more harmonized coverage organization.
But will you change the remuneration structure? Do you think there's going to be a radical overhaul of your remuneration structure?
No, not really. I think it's already exists today. They already work quite well together. We don't really need to, because it actually works today. We think it can work better by simplifying and give people a very clear direction.
Look, George has cut down. He talked about an inevitability of job cuts.
Yes.
Look at the executive board. I mean, he sliced that from 18 to 12.
Yeah.
Can I expect a similar cull within the management structures, the layers that you want to take out? Are we going to see that scale of downsizing?
Yeah, now, George was very, I think, upfront and frank. There will be job losses. However, our approach is very, very different from what you normally see. We have a strategy. We're not going to change the strategy. We're taking an organizational design and marrying it with the strategy. So we're purposely, doing so in a very thoughtful way. It's a purposely built type of approach. What we don't want to do, and everyone is asked, what's the number? How many headcount are going to be reduced? That will come out of what we're doing today. So what we did not want to do is to come out with a approach that had a headcount number. That means you have to backfill job losses into a number. What we want to do is to create a strategy that fits with our organizational design, and everything else will come out of it.
It was an exclusive conversation with HSBC's Michael Roberts. And I think, Danny, look, Michael has taken on probably the single biggest revenue producing, taking commercial bankers and investment bankers, putting them together. So that's a cultural feat in itself. The rest of the conversation is around this. Are you going to do it slowly, like drip, drip? He said, no, I have been through that before. That is not how we're going to do this. It will be measured. It will be thoughtful. And it's going to start at the top tier of management. They're going to take out layers of management. And as I said to him, the board has already been sliced from 18 to 12. So this will be a significant reshaping of the bank, but it's not going to be done in, that sort of piecemeal way that you see in some other banks.
I was going to say, because Citi is grappling with the restructuring now, and a lot of the criticism has been kind of, why aren't you hurrying things along? I really recommend everyone listen to the full interview, Manus, because you had a really interesting discussion about tariffs, too. This idea, as he said, that there will be retaliatory tariffs. The U.S. isn't just going to stand on its own. There will be consequences.
Absolutely, and that's the risk to growth. He also thinks the markets have, guess what, gone a little bit too far, a little bit too fast, a little bit over-exuberant. Strange that. Coming up, we'll set you up for the trading day right here on Bloomberg.
What a year this week has been. Let's get you set up for your final trading day of this week. Paramount will be reporting earnings before the opening bell, then the latest UMich consumer sentiment at 10 a.m. Then that will be followed by Fed Governor Michelle Bowman's remarks at 11 a.m. Manus, a lot to look out for, but kind of a boring day in the context of this week.
Well, probably a little bit of a sigh of relief as people reassess this Trump trade. Still, the S&P 500 had its best week so far this year, all-time highs, breaking through 6,000, Danny. And I think it's a question of U.S. exceptionalism, and Powell said that himself.
Right, and it's what is this market pricing in when it comes to bonds? Is it inflation or is it growth? If you look at risk assets, that would suggest growth, considering the stocks, considering credit spreads, IG, their tightest since 1998. Okay, that's it for Brief. Surveillance will take it from here.